There's a man in the audience who we call the man of many cycles, who helps us put this current cycle into some perspective. So please join me in welcoming Bill Tucker. Bill. Okay. Now, Bill, cycles. Let's start with the question of cycles. You've seen a few in the Brisbane market in the last couple of decades. Do you think that, given that the cycle has moved so much now and prices have changed so much, you saw that yield curve starting to stabilise, do you think it's time for investors to get back into the market?
Kevin, it really depends on what kind of investor you are. You know, if you're a relatively short-term value-add trading type investor who's looking to buy something and trade out of it in 2 or 3 years, well, this is definitely not the market for you. If you're a very long-term investor or a sort of a medium-term investor with a 5 to 7 year investment horizon, then I think you should definitely be looking at Brisbane now, because in theory there should be some pretty good counter-cyclical buying.
Sorry, in theory? What do you mean in theory there?
Just a theoretical kind of guy.
Okay.
I say in theory because the situation we have now in the market, with a few exceptions, there have been a few sales, is we've got a bit of a standoff between the buyers and the sellers. You know, as we know, the buyers set the market on the way up and the way down, and the buyers look at the office market fundamentals, which you've just gone through, and see really no rental growth for probably 5 years on average. So they say to get the total return they need, they have to get most of the return out of the initial yield. So the pricing we've seen in the market's probably at about 200 basis points above the peak in 2007. On the other side of the equation, the vendors, in some cases, have been prepared to meet that market. In other cases, they haven't been prepared to. And in recent cases, things have actually been withdrawn from the market, not only in Brisbane, but around the country. In the Brisbane market, you know, I think if people are withdrawing stock because they've decided that they're just going to tuck it away and be a long-term investor in this market, that's fine, because I'm a big believer in the long-term Queensland growth story. And, you know, somewhere out on the horizon, it's actually out of sight now, but somewhere out there's some rental growth, which eventually will come, and so long-term, that should be fine. If people are pulling things off the market because they think the market's going to be a lot better in a year or two, I think they're going to be pretty disappointed.
So, I mean, you're in a lucky position because you get to take the inquiry that's coming in from the marketplace for assets in Brisbane. Tell us a bit more about where the inquiries come from in the last 12 months.
Okay, well, in the last 12 months, with one exception, and that was the sale of 157 Ann Street to CBRE, which is the City of Brisbane Investment Corporation, all the buyers have been private investors.
Okay, there's a list of them there. So what about if we go forward the next 12 months? How do you think that's going to change? Do you think you'll see other investor types coming back into the Brisbane market? Yeah, there's actually been a little bit of a change in the market just in the last 2 or 3 months. The private investors are definitely still there. I mean, there's a little bit of a broader demand in the market, but it's all constrained by access to capital. The private investors are still around, and they're, you know, if they have good access to debt, well, then they can, you know, play up to $100 million plus, but more likely in the sort of $25 million and under range. As you pointed out, the REITs have raised about $19 billion in capital in the last 12 months, albeit expensive capital. And we have seen 2 or 3 of the REITs actually back in the market making offers just in the last 2 months, so that's sort of new territory. And then also some of the wholesale funds have started putting together some new funds for opportunistic buying as opposed to sort of their existing funds. Some have the money already, some don't, but they're looking. And then we're even seeing some retail syndicators back in the market making offers subject to capital raising. But all the people we're talking to, who are the Australian-based people, are looking at Brisbane because they see it as a yield play. They're yield hungry, and they think Brisbane will offer that. Okay. What about foreign investors? We've seen, particularly the German funds, very active in Australia, buying a lot of stock in Canberra and Melbourne in particular. Does Brisbane offer the sort of type of buildings, the assets that would interest foreign investors? Yeah, well, if you look at the slides you've got up now that shows some of the things they've bought, I mean, the odd man out there is probably 15 William Street because it's an older building that's been refurbished, but most of the foreign investors are looking at relatively new buildings, WALEs of 8 years plus, preferably leased to government, that they can buy at sort of 7.5% yield. So yeah, Brisbane, especially the new developments that have come online, I'm not sure about whether the pricing will fit that bill, but the buildings themselves are the right quality. Some of them are leased to the right type people. So yeah, they'll definitely have a look at some of those things.
Okay, so let's wrapping up now. How do you, sort of in summary, see the investment market in Brisbane over the next 12 months?
Yeah, well, this is a question you and I have sort of grappled with the last couple of days, really. And my sort of gut reaction, I guess, when we first started talking about it was it's going to be a pretty terrible year next year. As far as stock goes, there wouldn't be anything available, which is not good for salesmen. The only thing that I think will change, I mean, the buyers aren't going to suddenly decide it's a 6 or 7% market again. So people are going to have to meet the market, and I thought, okay, what type of people might decide to meet the market? And the scenarios I can think of that could happen would be there might be someone with some debt that has to be reset. They have a little bit of difficulty with their bank. A lot of bankers here today, so I'm sure you'll loan people lots of money. That would be nice. You know, if someone has a debt problem, then it's possible something could be put on the market. We haven't really seen that yet. Haven't seen a lot of distressed sales, but it's possible. There are a few buildings around town that have ownership structures with retail syndicates or other sort of closed-in vehicles which are expiring in the next couple of years. It's possible the investors in those funds might want their money out, so that could generate a sale or two. And then the last thing is that some people might just want to take profits off the table now. I mean, if you bought a building before 2006, even selling it in today's market, you're going to make a profit. Some people might just not want to sort of battle through the next 5 years, which it's going to be a battle if you've got vacancies coming up in your building to get them filled, and it can be pretty annoying, I think. So there might be some people who want to take profits off the table. The other example would be some of the new developments. I think a number of those, even at today's cap rates, still would show a good profit for the developers, so possibly they could come up.
So it's an uncertain outlook in some ways, but I sense that there'll be a chance of some surprises, some surprise deals done over the next 12 months.
Well, it'll either be a year when I get to practice my golf swing a lot, or it'll be a year when people meet the market and we actually get some deals done.
Yeah. Okay, look, they're terrific insights there, Bill. Thank you for that. So please join me in thanking the man of many cycles, Bill Tuckle.
Thanks, Kevin.